You see the headlines all the time, right? A startup raises millions, then tens of millions, then hundreds of millions. But how do the investors who write those massive checks actually get their money back and then some? Well, that is the billion-dollar question in venture capital, and it all boils down to one single critical event: the exit. Today, we're going to unpack the entire VC endgame. And this quote, it just hits the nail on the head. It perfectly captures the VC mindset. See, they're not just looking to get their initial investment back with a little interest. No way. They are hunting for that golden exit, a massive payday that isn't just about what the startup is worth today, but about everything it could be. It's about capturing lightning in a bottle.
So let's get on the same page. What exactly is an exit? Well, to put it simply, it's the moment a venture capitalist cashes out. They sell their stake in the company, they give up their seat on the board, and they walk away. For a VC, this is everything. It's how they harvest their investment, how they deliver those big returns to their own investors, and ultimately how they prove their fund was a home run.
Which brings us right to our first key idea, the golden exit. For a venture capitalist, it's not just about picking winning startups. It's about knowing exactly when and how to cash in their chips. The exit isn't just an important metric, it's the only metric that truly matters. Without it, even the buzziest, most hyped-up startup in the world is just a bunch of unrealized potential on paper.
But when to pull that trigger, man, that is a massive dilemma. It's a lot like playing the stock market, but with way higher stakes. If you exit too early, you risk leaving millions or sometimes even billions of dollars on the table if that company just keeps skyrocketing. But if you wait too long, you risk the whole thing falling apart. The market could turn, a new competitor could pop up, anything could happen that just wipes out your entire investment. It is a super high-stakes balancing act.
So, okay, let's say a VC decides the time is right. The stars have aligned. How do they actually go about cashing out? Well, it's not a one-size-fits-all kind of deal. You can think of it like a menu of options, where each choice has its own unique flavor of risks and rewards.
And there are really three primary routes this whole exit thing can take. The most common by far is the trade sale, where the startup just gets sold to another, usually bigger, company. Then you've got a buyout, which is when the startup's own management or maybe another private investor buys out the VC's shares. And finally, there's the big one everyone reads about, the initial public offering, or IPO, where the company's stock gets listed on a public market for the very first time. Now, let's dig into that trade sale option for a second, because there are really two different reasons a buyer might swoop in. A financial sale is pretty straightforward. The buyer sees the startup as a money-making machine and wants its future profits. But a strategic sale, that's different. That's when the buyer wants the startup for its tech, its team, or its users. Just think about when Facebook bought Instagram. At the time, Instagram had zero revenue, like nothing, but it had a massive, totally obsessed user base and a killer mobile app. That was a classic strategic sale. And then, of course, there's the IPO. This is the blockbuster exit, the one that makes headlines, turning those private shares into public stock anyone can buy. It can deliver the absolute biggest returns, but man, it is an incredibly difficult and expensive process. And even after the big day, VCs can't just dump all their shares at once. They're usually subject to what's called a lock-in period, which basically prevents all the insiders from cashing out at the same time and crashing the stock price. So we've got the different ways out, but it doesn't matter which path you take, a sale, a buyout, an IPO, they all lead to the same, super thorny question: what's the price? This, my friends, is the great valuation puzzle. How in the world do you put a number on a young company that often isn't even profitable yet? I mean, that's the fundamental challenge, right? You're not just valuing what a company has already done, you are placing a massive bet on what it might do. You're trying to put a price tag on a future that is completely, totally uncertain. So how do investors even start to wrap their heads around that? Well, to try and price the priceless, investors basically have two main toolkits they can use. They can either look inward, trying to predict the company's future with a crystal ball, or they can look outward and just see what the market is saying. Let's break down these two paths. The first path, the internal one, uses a method called net present value, or NPV. This is where you try to forecast all the money the company might make in the future and then calculate what that's all worth today. The second path, and honestly the much more common one, is looking externally by using comparables. This is basically where you see what the market has recently paid for similar companies. Let's look a little closer at NPV. The core idea is actually pretty simple. A dollar that you might get 5 years from now is worth less than a dollar in your pocket today. That's because of risk and inflation, right? So NPV is just a fancy mathematical way of taking all those projected future dollars and discounting them back to a single concrete number of what they're worth right now. But, and this is a huge but, here's the massive catch with NPV. The discount rate you choose is really just an educated guess about how risky the future is. So, for example, using a 20% discount rate, this company we see here is valued at over 17 million bucks. But if you think the future's just a little bit riskier and you bump that rate up to 40%, look at that. The valuation gets sliced by more than half, down to 8 million. That one single subjective number becomes a huge bone of contention in any negotiation. And that's exactly why most VCs lean so heavily on the second method, comparables, or comps. The analogy here is perfect. You price your house by seeing what similar houses on your street just sold for. Well, in the same way, VCs value a startup by looking at what similar companies have recently been bought for, or how they're being valued on the stock market. It's grounded in reality. Let's walk through a super simple example. Say our startup here has $10 million in revenue. We go out and find two similar companies that are publicly traded. We see the market values company A at 3 times its revenue and company B at 4 times its revenue. So a fair multiple for our little startup is probably somewhere in that range, right? If we just take the average, 3.5x, and apply it to our 10 million in revenue, boom, we get an implied value of $35 million. See? It's all based on real-world market data. So you've got your menu of exit options and you've got your valuation methods. How do you make that final, critical choice? Well, the truth is, the decision isn't made in a vacuum. It's a complex dance that depends on the health of the startup, the temperature of the stock market, and the unique goals of every single person sitting at the table. All right, let's just quickly recap the key takeaways here. First, the golden exit is the engine that drives absolutely everything in the world of venture capital. The main ways to get there, a trade sale, a buyout, or an IPO, each have their own pros and cons. We learn that valuation is way more art than science. It's a negotiation between a forecast of the future and the reality of today's market. And finally, always remember, especially in a strategic sale, the buyer isn't just acquiring a company, they're acquiring the valuable synergies that powerful combination creates. And all of this leaves us with one final, fascinating question to chew on. In a world where markets and technology are changing in the blink of an eye, what is the true, lasting source of a startup's value? Is it the promise of future profits? Is it its competitive position in the market? Or is it something more fundamental, the unique and difficult problem it solves for its customers? Answering that, well, that's the real endgame.